Hello, fellow traders. 'Tis I, the Rumpled One, coming to you late Monday, April the 4th. The year is 2022. Let's talk trading risk. These videos are for educational purposes only. Your results may differ from mine. Yes, I'm coming to you a little bit late today, but it still is Monday. Risk. This is a screen you've seen if you've been watching my videos over the years. You've probably seen this screen a few times. I have to laugh. Anyway, risk. It's something that, on the one hand, is really simple. You know, how I define it is it's how much a trader is willing to lose on any one particular trade. It's the maximum that they're willing to lose. It can be expressed in a dollar amount or percentage of your account. And so, risk management, why is it necessary? Well, it's because in trading, as I've been mentioning lately, it's not like baking. When you follow a recipe and put the batter in the oven, you know what you're going to get after, so long as you set the temperature right and you leave it in the right amount of time. If you pull it out too soon, no good. If you pull it out too late, no good. You've probably got a couple of minutes, plus or minus the exact time that you can take whatever it is you're baking out and it'll be okay. Every time. But you see, with trading, not so much. And like I said, I have discussed this. So the point is that we don't want to bust out our account not in just one trade. No, we don't want that to happen. We don't want to bust out our account in a bunch of trades, but that could happen. And so there are people who have created some pretty interesting formulas to make sure that doesn't happen. So some people always trade the same position size and always have the same stop loss. Others might be the market structure guys I like to talk about, where sometimes the stop loss might be 10 pips away and sometimes it might be 22 pips away. So they want to keep the risk the same, so they adjust their position size. Either way is okay. But then there's some people that say after each and every trade, you readjust the risk. So for example, if you have $1,000 account, and let's just use a big number. Let's say you're willing to lose $200 on a trade because you don't think you're going to lose 5 in a row. Well, what happens if you lose, let's see, if you lost 4 in a row, and then you won one, and you lost how many more in a row, and you'd be tapped out? Well, you don't want that to happen. So what you would do is, if you're saying, okay, if on that first trade you're willing to risk 20% of your account, $200. Well, if you lose that 200, now you're down to 800. So 20% of 800 is 160. So what happens is, as you're losing, the amount, the dollar amount you're losing is shrinking. On the other hand, if you're winning, and let's say you win, so now you've bumped it up to 1200. So now your position size is going to be a little bit bigger because you've got more money. So that's just another way of looking at risk. But it's just something that I thought I should mention because it's one of those things that it's easy to take for granted that everybody's on the same page when it comes to risk, but it's not always the case. So you can do something, very simple like this. You can decide whether or not you want to adjust your position size and each time if your account goes up or down, those are individual choices. It's just that, based on the science, the math, the statistics, it comes out that it's best to reevaluate each and every trade. Now, I was talking to Walmart about it. He says, well, that I'd have to go in and adjust this and adjust that. And, that was too much. I said, well, you can always write an EA. So rather than use the standard, um, you know, buy and sell buttons, you can write an EA that puts out your customized buy and sell button. So when you hit your buy button or sell button to enter a trade, it would automatically put in a stop loss, and maybe it could automatically put in a TP. So one button, then you can just pretty much sit back and watch. Um, and it'll do all the math for you, so you don't have to sit there with a calculator or whatever. And that's just one thing to consider. And no, I don't have any EAs that I'm going to put out there for public consumption. I've already told you why I don't do that. So even sometimes people ask me, via private message or email if I'd write them an EA, or it's like, no, 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 just not going to do it. So let's take a look at the charts here. For the month of April, we're 21 pips below the open, 28 off the low, 39 off the high. And as you can see, it really hasn't moved that much. We're in the lower wick zone of the previous month. Seems like it got out, but now it's back in. On the week, we've got a green week. We actually exited the lower wick zone of the previous week, but now we're right back in it. Notice there's that weekly pivot that didn't get hit from last week. That's still open. And let's see, all the gaps have filled. So here is the opening range for the week. Here's the opening range for the month. So you can see there, this was almost an inside bar, but I think we broke out by about a pip on the downside. So 417 pips below the yearly open. So still wondering about that seasonality indicator, and I'll show you a little chart in a few minutes. Taking a look at that, doing some analysis. Okay, inside bar 3 days ago, short trigger 3105. We're 4 pips above, actually 3.4 pips above it. Long trigger at 3175 if you're trading the inside bar. But you'd probably take this break and or this break going to the north before waiting. There's no reason to let it move 66 pips before you enter long. That's almost the range that the pound's been moving in a day. So I think you might be a little late to the party if you were to do that. But if you were stacking on prices moving your direction, that's something to be considered. As you can see here, we are, as far as my broker, it's April the 5th and we're 7 hours into it. We only have a 16 pip range. And you can see here, crisscrossing the daily open. We're above the weekly open. And this right here, looks like a return bar to me. This here looks like a return bar. And remember, I think the other day I mentioned this was a return bar. Well, you can kind of see what happened there. And it's too early in the day for the rat zone. Yesterday, the rats had a good time feasting. And because it was pretty much a range-bound day. A lot of oscillation. Price near pivot, bias is long. We just crossed to the downside across the pivot. So looking at S1, if it gets down here, that's your next long anywhere near R1, it would call for a short. And here we took out the pivots. Up until 6 days ago, we've got a missed pivot. As I mentioned earlier, here's a missed weekly, another missed weekly. And for the month, 31.89 and 34.43. We've got 2 missed pivots this year, and they probably will get taken out based on history. But then again, anything could happen, and we might not ever hit those pivots this year. We'll just have to wait and see. That's why we use stop losses. In and out of the upper wick zone on the daily here for the horizontal line traders. Price action traders with the scalper, higher low, lower high. There was a nice short here around 20. If you scrunch the chart, you can see how price just isn't wanting to stay above that 20 level. It's dropped once, twice, 3 times, now 4 times. So it's just something to take a look at. Simple price action with the Walmart lines. It broke out of the previous hour, but once again, these hourly ranges aren't that big at the moment. And for as far as the ATR, too early in the day, no ATR movement. Let's see. I wanted to show you something here on the year-to-date range by month. And this is showing close minus open. So red means it was a bearish or red candle. Green means it was bullish or green candle. Take a look at April. Remember the seasonality indicator. And so you can see out of the last 20 years, we've had 3 Aprils that were red. And the current one is red, which is telling me if price gets near that monthly open, go long and bet long, and just based on these statistics. And this could stay red the entire month, but that's just a statistical trade that I'm looking at here, giving you the heads up on it. And once again, trading away from the open when you haven't hit, X% of the ATR. It's just another way of getting a bias. After you've reached a certain percentage of the ATR, then your reversal trades are okay. And then looking at the H4, another set of pivots that I like to use as a bias. The only one that I see open is here, which right about 1.32. It's just something to, I'd be looking for those longs because it's something, that would correspond with some of those other charts we just went over. So once again, we're talking about risk. So we put the trade on, we hope for the best. We say that the worst is not going to be any more than a certain number of pips or dollars that we're willing to lose. And then we take our signal the next time and the time after that, because we know hopefully that our method's going to pay out. So, fellow traders, you might want to ponder risk for a while and just revisit how you're doing it and make sure it's working for you, because it's not what you trade, it's how you trade it. So go out there and drain the banks. This is the Rumpled One, over and out.